Good afternoon to our friends here on the East Coast. Good morning to the rest of the country. Appreciate you dialing in today. It's tax time, and it seems to be the buzzword with a new regime change and coming in and year-end planning to be had. We thought this was a topical subject matter that will give you some speaking points with centers of influence, clients, CPAs. So today's call is really meant to keep several sales ideas or speaking points at a high level. And should you be interested in any follow-up material, we'll be sure to send the full one-pagers that we're about to display that you can utilize with clients and centers of influence. So first and foremost, I think it's important to set the table. Here's a quick agenda here. I have a few of my teammates on the call: Alan Busby, Nick Crescenzo, Adam DeMarco, and we've each taken a subject matter, and you're going to hear from each of us. I'll moderate the call, and I'll also share some ideas from time to time. But I think what's important is to really kind of set the table on what we can expect. There's so much discussion around elections and Congress and the Georgia runoffs. And I'm seeing solicitations to attend webinars to learn about post-election and the Biden plan. But I can tell you that we are an ambassador at AALU, and no one is really as dialed into trends and what's forthcoming than AALU. And I can tell you that the January 5th Georgia runoff is going to be the deciding factor. So if anyone tells you what the tax landscape is going to look like before the Georgia runoff, I think it's pure speculation. But what I can tell you is the information and the data that AALU has gathered thus far, and there is going to be a very high probability that we're going to have a divided Congress, and which means there's a very low probability that there will be a Democratic sweep to both seats in this Georgia runoff. What that means in a divided Congress is that there will be no major tax overhaul like there was after the Trump administration took control of the White House and the Senate and in the Tax Cuts and Jobs Act. So we're not going to see that in all probability. However, there will be small changes that will occur that align with the Biden plan. So you should be aware of the highlights of the Biden plan and as it pertains to our business. And that's all I'm going to cover today on how it pertains to our business. One important note is that Mike Crapo from Idaho is likely to be the next chair of the Senate Finance Committee. So if you are an AALU member, I can tell you the PAC is throwing money his way. If you're going to endorse him individually, they're throwing money direct to his campaign. And if you haven't met your AALU commitment, you are likely to be asked to contribute to his political agenda. So, having said that, we're not expecting major tax overhaul, but the Democrats will look for small victories. And I don't think there's any secret that both Republicans and Democrats are looking for revenue. And some of these bullet points on the Biden plan will be bartering chips to be had in other different bills. So you need to be aware of what the Biden agenda will look like. Number one agenda, and we think that there may be some bipartisan support on this one, and that's why I ranked it at number one, is to restore the estate and gift tax rate and exemption to 2009 levels. So the $11 million exemption will almost certainly roll back if we don't get to 2026, where it eventually sunsets on its own without any approval needed in Congress. Bullet point 2 on the Biden plan is high earners. He's looking at his wish list is to tax capital gains at 39% level, levels for individuals earning over $1 million. He thinks it's fair and equitable, and there's probably some merit to that. It may fly. He wants to eliminate the step-up in basis for capital gains. This presents a tremendous opportunity to sell life insurance. It presents tremendous opportunity for accountants to go back and figure out basis from 20, 30, 50, 70 years ago. So this will no doubt create a lot of confusion, but also promote the use of life insurance. The Biden plan looks to phase out Section 199A for business owners with taxable income over $400,000. So you keep hearing that $400,000 number tossed around in debates and different town halls, and that's really where it's coming down. It's coming down to. There's been some pretty significant qualified business income deductions able to be had over the last few years that the Biden plan looks to phase out. And lastly, raise the corporate tax rate from 21% to 28%. I don't think anyone thinks that's going to happen, particularly with a divided Congress. But there may be some incremental increases to that number. So what we do think will get done, and possibly even in this lame duck session that we have here, that there's huge bipartisan support to continue to piggyback off of the Secure Act, which promotes retirement plans and savings. So there's a huge deficit in retirement savings and potential retirement income here in the United States. So what this retirement bill will look like, and it's actually introduced in some fun facts here. It was introduced by a Democrat named Richie Neal, who happens to be a former Mass Mutual career agent, right? I think, which is pretty neat from a perspective of the insurance distribution partner, and Kevin Brady. So you have bipartisan support, who's a Republican out of Texas. And the big thing here is that you're automatically going to be able to participate in 401k plans, and it's going to be required by employers to allow that for both full and part-time employees. So promotion of savings and closing the retirement crisis, the gap in retirement here in the United States. They're going to repeal the max ages for contributions to IRA, so seniors and more mature clients can continue. They're going to expand the savers credit, and they're going to increase the RMD to age 75. Now, whether all these bullet points end up in the final bill remains to be seen, but I can tell you this will likely happen, and it could possibly happen in the next 3 weeks. So here we are to discuss tax mitigation strategies, tax efficiency. And at the end of the day, we're here to sell life insurance. We're here to service you as our agents and our clients. And the purpose here is to provide you with some ideas around how to sell life insurance in the topic of taxation, and capture this opportunity and this buzz around the subject matter. So back to old trusty here, tried and true technique. A small business or medium-sized business can install a qualified plan. There are two types of qualified plans. There are defined contribution plans or defined benefit plans. There's still time to adopt. So if you're doing any tax planning and you're looking at your estimates and you see that you have a significant need, there are companies that have done extremely well in this COVID environment, whether it be food or contracting or different industries that have thrived, shipping. You can defer some of those profits through tax-deductible contributions in a qualified plan. The purpose here is to reward the owners and key employees and provide a meaningful benefit to the rank and file. What's interesting, which I'm going to throw out here, and you hear us talk about reviews all the time when it comes to life insurance policies and disability policies and buy-sell reviews. Well, there's no difference here. We can absolutely review a client's qualified plan, see if they're maximizing the contributions to the owners. We typically like to drive 75% or more to the owners if we can help it. And we will certainly want to make sure if there's a provision to allow the permissible purchase of life insurance inside the plan. So, back to where I was headed with this, right? It all depends on your budget and your ability to contribute consistently, which will determine what type of qualified plan we're going to recommend. And the study that we'll do for you is also complimentary to just kind of give you the most efficient use of a qualified plan, where a defined contribution plan is, in one aspect, just defining how much you're putting in, where a defined benefit plan is defining how much you're taking out. Defined benefit plans is what we're going to focus on here, because here's where you drive some really significant deductions, and I'll share with you why you may want to add some life insurance to these particular plans. So, the perfect scenario is a small company, fewer employees, highly profitable, stable profitability. These plans need to be permanent and ongoing, so you want to stick with them at least 3 to 5 years in the IRS eyes. So you can't shelter a bubble of income and stuff a bunch of money into these plans and then walk away from them. Older owners, younger employees, they work great. In our company, Adam and I are younger. Our average age is 42 between us, but the average age of the rank and file is 47. So we're on the cusp of looking at a program that makes sense for everyone versus just doing some type of compensation bonus or some type of reward. The benefits of adding life insurance, this is what we're here for, right? Premiums are paid with tax-deductible dollars, which free up your personal dollars. So if a client has a need for life insurance, the analysis should be run, and we have a one-pager. You're probably not surprised if you've attended webinars with us in the past. We have a one-pager to help you determine what do you have to earn, or what do you have to liquidate by way of your existing asset to utilize after-tax dollars to buy life insurance. Qualified plan alleviates that issue. So if you're rocking and rolling on your non-qualified assets and you don't want to liquidate and you don't want to have to earn 40, 50% more to net the same dollars to buy your life insurance, you can add it to your qualified plan. Should death occur and you didn't have time to accumulate your retirement goal for the benefit of your family, the life insurance proceeds obviously complete the plan for you. And at retirement, we've been employing some creative strategies on either purchasing or exchanging those policies from the qualified plan, so they're not stuck in that qualified status forever, so that you can come out and have personal or trust ownership to provide that continuous protection for you and your family or your client's family. So how does it work? It is in the most simplistic form here. Assuming you're in a 34% bracket, and our one pager will show you column by column, year by year, and cumulatively what if it makes sense. But if your gross amount to pay premium is at $12,000, policy terms being equal here, right? $1 million, 45 whole life. If the premium's $12,500 in the qualified plan, it costs you $12,500, and that's a pre-tax dollar. If you're actually paying for it non-qualified in a 34% bracket, you have to go out and earn $18,939 to pay your taxes due of $6,400 and net the same $12,500. So here again is how you are avoiding the need to liquidate other assets or have to gross up a non-qualified structure. Quick census. You got husband and wife business owners. Mom's taking a modest $60,000 wage. The company is profitable, right? One of the fun aspects of having a pass-through entity, LLC or S Corp, is that you don't have to hit and pay all the Social Security type taxes in your W-2. You can take them as K-1. And so mom and dad each taking a $60,000 annual wage. You have $120,000 of wages. I could, in theory, create a retirement plan that gives mom and dad 100% of that $60,000. So create an income stream of $60,000 at their normal retirement age by installing a pension expense. They're showing us that they're taking $400,000 of K-1, so it's a profitable business, which in this instance would afford them $150,000 qualified plan tax-deductible contribution, which would each accompany that program with $1 million of permanent death benefit. Items needed for a plan design, it's really simple. We need a census. You probably already work with their health insurance plans or their retirement plans and need an employee census, 2-page fact finder. And if they have an existing plan, we want to see a copy of that document. We can do a custom study for you. So I'm gonna pass this to my associate Alan Busby. We're gonna talk about the quite opposite, the tax impact of investing versus the tax-free nature of life insurance in a non-qualified um, setting. So what you'll see with Alan here is that his client base and his advisor base is typically on the more sophisticated side, where they are getting hit with some pretty significant income tax rates. You'll see how a life insurance wrapper can create some tax mitigation in exchange for paying policy fees and death benefit. So, Alan, can you give us some insight on what you're seeing in the marketplace and why clients and agents are considering the life insurance solution?
Yeah, thanks, AJ. 2020 has certainly been a crazy year, and we've spent a lot of time and focus creating content. And I'm going to share two pieces of output that we've created that highlight the tax efficiency within life insurance as it's compared to an alternative investment. And I think the biggest pushback that we get as insurance professionals is that insurance is expensive. A quick Google, quick dictionary definition will tell you that expensive is, by definition, costing a lot of money. And I think you'll see on the next slide that there is some truth behind insurance being expensive. But at the same time, I think everyone on this call and certainly around the office, we would agree that taxes are also expensive. And I know we're not anticipating an increase in tax rates maybe as soon as we thought, but it's very well could happen. So taxes are expensive. Insurance, as you'll see on the next slide, can be expensive. So that leads us to two trades: policy charges for tax efficiency and investments, fees, and taxes for tax efficiency. So this is our good friend Anthony Mento. It's an example here, $48,000 a year going in over 10 years. I mean, you'll see here on the left side with a 1% management fee and an investment account, not overly expensive, right? Year one, $514, year 20, $12,000. As opposed to the insurance on the right side, it's expensive, right? Costing a lot of money. That's a lot of money for an investment. But again, the trade-off, the bottom left, your investment account, you've got a taxable distribution. And in your insurance policy, as we all know, we have a non-taxable distribution. So what we've done is created an output that highlights the cumulative taxes and fees that are paid within an investment account. What this is basically from left to right, you have your annual distribution going in, your income coming out. We go over the tax-free portion coming out, the gains coming out, all the way from left to right. And the real meat and potatoes is not that flour. The next slide. Perfect. The fees and the taxes. So columns 9 through 16, I mean, you've got your account balance. You've got in column 12, your annual loss due to fees. So as you can see, again, when we talk about tax efficiency, when we talk about something being expensive and costing a lot of money, right? In the early years, not that expensive. You get over to columns 14, 15, and 16 is really when you see what is expensive, and it's your taxes. That's coming out in your distributions in column 14. And then in column 16, you see the cumulative value of your fees and your taxes. I mean, you're just shy of $500,000. So final piece of the output, we compare it to insurance, right? Left-hand side is your investment. You've got your deposit going in for 10 years, your income being drawn out, columns 1 through 6. And then in columns 8 through 15, we show tax-free distribution of life insurance. You can see there it's a mirrored amount, right? $92,000. And you can see how much longer it lasts. And that's solely from the impact of the fees and taxes. This is a variable contract. It is compared to an all equities portfolio. If you have a bond portfolio, we'll typically mirror that with whole life. If you have a blended portfolio, we'll oftentimes mirror that with a low cost index product, but again, can be catered to your client, your portfolio analysis. So all customizable. And yeah, the other thing I wanted to touch on was very high level and quickly was private placement life insurance. Again, been a crazy year, 2020. A lot of clients are going to be seeing gains in their alternatives, their private equity accounts, and they're going to be getting hit with a tax bill, right? Gains are taxed at ordinary incomes. You can see there on the right-hand column what those tax rates are. Again, not anticipating an increase in tax rates right now, but again, could happen. Regardless, 20, 30%, going back to costing a lot of money, being expensive, that's a lot of money to give up to Uncle Sam. So we're seeing a lot of people being interested or talking about potentially moving their alternatives, their private equity, to this private placement life insurance solution. Again, one-page output. Left-hand side, we take into account different tax brackets. I believe these are 40, 50, 60. Obviously, they can be catered to your client as compared to a life insurance solution within private placement and a tax-free wrapper. So 2 quick ideas. Outputs can be customizable to your client, and good.
Alan, you're giving me a lot of credit here. You're assuming that I'm going to buy and hold until I'm age 64, and as I sit at my desk and I watch the ticker, and the market's going up 4% on a given day, or down 5% on a given day, I would tend to argue that the turnover rate is going to be far greater than 0, which we're assuming here, and that I'm going to probably trigger some short-term and some long-term gains earlier on. But this analysis does give the client the benefit of the doubt that they buy and hold through age 64. So great job, great piece. And again, folks, we can easily send you these one-pagers. I know they're difficult to see in a slide on one screen, but if you have the PDF where you can manipulate the size in and out, you'll be able to digest that information a little bit better. So
all customizable, plug and play.
Yeah, thank you, Alan. So the next subject we're going to dive into, and I'm going to ask my associate here, Nick Crescenzo, to help me with the presentation, is if you are a business owner and you are providing a solution either for yourself or for a key person, do you bonus the premium or the means to pay the premium, or do you lend the means to pay the premium? And if you don't take anything from this call other than this particular rule of thumb, I would say that this was worth your investment of 45 minutes. If your corporate tax rate is lower than your personal rate, well, then you do not want to pay those premiums out as wages. You want to lend. If your personal rate is lower than your corporate rate, then give the benefit to the corp and take the premium or contribution as a bonus, right? We're talking about taxes. If you very simply want to open a conversation with a business owner, this is a wonderful starting point in just following this rule of thumb. So in the most simplistic form, an executive bonus is in an instance where you're either providing a benefit to a key person, or you're an owner with a lower tax bracket than the corporation, right? This is a program where the business uses tax-deductible company funds to provide a benefit to a key person. And in this instance, the executive pays the income tax on the bonus as they would any other wage or compensation. And this is probably one of the very first strategies you learned when you came into the life insurance business. But where we've evolved and where we've crafted a certain level of sophistication is that second piece of where the executive pays the tax, which is unpleasant, right? And again, it's tax time. So to bring an idea to a center of influence or a business owner that gives them the option on how to handle that second piece, whereby if that particular executive hits 70% of their annual goal or greater, and I'm just spitballing some really cool performance-based incentives, then the employer may make an additional loan to that executive to help him or her pay that tax. You could align that executive with a bank to finance that tax and create additional leverage into the executive bonus program and have the entire contribution working for you versus a fraction of it because you're losing some to taxes. So I think we have some fun with this one because there's some high profile celebrity type cases that have adopted the second piece of the strategy, right? The cardinal rule was if your personal bracket is lower than the corp, you bonus. If your corp bracket is lower than the personal, you lend. And here's where we're going to show application in for-profit and not for-profit companies. And my friend and associate Nick Crescenzo is going to share with you some ideas on things that he's seeing in the marketplace.
Thanks, Anthony. So, the first thing you obviously have to do is identify what type of organization you're working with. There's nonprofits as well as, for-profit. And just in 2017, when the Tax Cuts and Job Act was passed, that's when they came out with the Section 4960, which is the excise tax, when we're talking about bonusing and loaning and all of that type of stuff. So any denomination over $1 million out of salary, whether it's bonus, that's actually taxed, and it's taxed at 21%. And as you said, that's not a pleasant tax. So when we're talking about, loan regime split dollar and how we can kind of reduce those tax amounts, this is one of those ways. Some of the notable in our area, we're in South Jersey, which not far from Philadelphia. Some of the notable nonprofits in the Philadelphia region, here's the top 10 list, some big names out there, UPenn, CHOP, Temple University, some big players in that nonprofit space. And these are designed to, these nonprofits are large in the area. And also I kind of want to touch on the actual split dollar logistics behind it. Which, in a basic, simple scenario, the employee is going to own the policy, and the employer is going to pay the premiums by way of a loan. So he's going to loan those premiums to the insured. Now, there's multiple ways that you can do that. You can, as Anthony had, touched on briefly before, we can, on those loans, the taxes that are due, they can pay those taxes, or they can actually bonus them out enough to actually take care of those taxes as well. The employer is going to have the collateral assignment on the policy. That's going to be, that'll stand for the length of the duration of the employment, whether that's 7 years, 10 years. So that way, they're covered on their side. So it makes sense for the employer, obviously, and they also want to try and retain these employees. And like I had mentioned, the loan interest is going to be taken care of by the employer or the employee, depending on how it's structured. Now, real quick, as Anthony had said, this is kind of a fun one. They actually used life insurance and split dollar in some sports. Nonprofits could be universities, could be hospitals. In this instance, we're talking about some big names here: Jim Harbaugh, Michigan head football coach; Dabo Swinney, head coach of Clemson; Ed Orgeron just won the BCS championship last year, LSU head coach. Dawn Staley, they're using this ideology to retain their employees. Just a quick case study here on an orthopedic surgeon. This is kind of a dramatic approach here, but we're going to look at the conventional approach, which is just a straight $1 million salary with a $1.5 million bonus. That bonus is over that $1 million threshold, so it gets taxed at 21%. You're looking at all in for the nonprofit at $2.8 million. And then total package for the key person, 2.5. So, we're looking to try and reduce that excise tax. Like I said, here is going to be a dramatic. We're taking the excise tax all the way down to zero, so there's no bonus, right? But we're putting an additional $2 million into this split dollar approach cash value. So where there's, like I said, there's going to be no excise. You're going to retain the employee for 10 years. If they leave, then you can get the premiums back by way of cash values. Total package for the employee here, compared to the 2.5, you're looking at $3 million. So there's a benefit there. Also, the nonprofit is going to actually be saving, $1.8 million if you look at the difference there between the two. And as we said before, you're saving the excise tax where you're just getting rid of the money. The money's going to Uncle Sam. And you're going to retain that employee for 10 years. You're giving the key person an additional $500,000. And with that, it's also going to come a $35 million death benefit. Anything happens, in those 10 years, with an income stream in retirement for $2 million, which is going to be a cumulative retirement income of $40 million. So it does add that, additional layer to kind of incentivize that employee to stay with, in this instance, the hospital. And, there's other areas that we can use this as well, especially in the corporate space.
Yeah, as Nick had mentioned, I mean, it's a pretty dramatic approach. I don't know if anyone would waive their $1.5 million bonus, but if it was in exchange for a $2 million private split dollar contribution, it starts to raise some eyebrows. And it's become a really powerful negotiating tool, as you've seen in major universities and hospitals. So, although the Jim Harbaugh case is the cool one to talk about, you're seeing it in virtually any not-for-profit with a highly paid, important executive or physician that's instrumental to the long-term success of the organization. And as Nick said, it's fun to talk about the not-for-profits, but what about the for-profits? And if you just kind of focus in on today's environment, the corporate rate for C Corps is typically lower than the personal rate for individual taxpayers. So in this instance, the rule of thumb is to lend, right? Recognize the tax at the corporate level at 21% and then lend it out to the business owner or key exec with a potential cost recovery mechanism. And what we're showing you here is a rollout from years 21 to 25, and then the executive and the family trust owns the policy, from here on out. But again, we happy to share these particular one-pagers. While we're on the lines of C Corp and tax discussion, I think a big item in the world of COVID is, how do I maintain my independence and stay at home in the event that I can't complete 2 of 6 activities of daily living? And my partner Adam here has done a really nice job in launching this particular line of our business. We were primarily a life insurance shop, and as we continued to read Wall Street Journal articles on long-term care and see the disruption in the space and the gaining popularity of linked benefit type programs, we began to really dig in and make this a core business line of ours. And Adam spearheads that initiative. What he's sharing with you today are some things that he's been doing successfully with some of our agents, and almost all of these strategies involve some type of tax planning or tax efficiency. So Adam's been at this for a long time. He's highly technical, and Adam, give us some ideas on, everyone thinks of premium as an expense and taking it out of savings or earned income, but give us some ideas on some non-traditional funding sources to back these particular products and programs.
Yeah, so thanks, Anthony. A lot of the policies today have adapted to accept all kinds of different types of funding. So there was a big change a couple of years ago in the way these policies were designed, where they started to, it looks like a little change inside the policy. They tell you how much the life insurance costs. They tell you how much the long-term care costs. And it was, on the surface of the policy, you look at it and say, oh, that's interesting. But the application of that is huge, because if we know how much the long-term care costs, long-term care has different rules by the IRS. It has different deductibility, and you could have all kinds of different funding sources that didn't exist before. So something like HSA money, for example, if you had money in an HSA, you could use it for traditional long-term care. You can't use it for life insurance. But if it's a life insurance linked benefit policy that has life and long-term care, then you can use it. So if you want to look at the particular policies that we're suggesting here, they're equivalent to kind of like Lincoln's Money Guard policy, although there's a lot of clones out there. I use Lincoln Money Guard because that's been around for 20 years and it's the most popular product in that space. But these are policies where we're not talking about an outright purchase as much as doing an asset reposition. So you're taking $250,000 on your balance sheet and you're moving into a policy that's going to be worth the majority of that $250,000 right away. And long term, you're going to be worth $250,000 guaranteed forever. So we're not asking clients to spend money. We're asking them to reposition their assets and to forego interest to create leverage for long-term care purposes. So we're asking them to take the $250. It's going to be worth $250 today. It's going to be worth $250 in 20 years if you need it. If you pass away, it's worth more than $250. And if you happen to go on claim, it's worth significantly more. We're talking about $11,000 a month of indemnity benefit for 6 years, which is over $800,000 of benefits. So we're taking a portion of your assets and we're protecting a bunch of it by not asking you to really spend money. Again, we're just foregoing interest for the insurance. So when you take that into account, and Anthony, I apologize, just to go on to the next slide here.
Adam, can you just give the audience a quick breakdown on how that $250,000 is spent and how you showcase this in the top right?
Yeah, so the $250,000 here is represented with $138,000 that's going towards the life insurance portion, the cash value portion, and then there's another $111,000 that's going towards the long-term care. And the importance of what Anthony's highlighting there is that any of the $111,000 that's going towards the long-term care, that's where you could fund it with HSA money. That's where you could take a deduction and it might not be reportable as personal income if it's from certain business settings. So this $111,000 out of the $250, by isolating the costs, we're able to access it and fund it with different ways, and we're able to, there's some tax efficiencies and arbitrages that exist. So for qualified money, we can do this. We can always take qualified money, an IRA rollover into an annuity to fund a policy. What's special today is that there's some products that they're not just hybrids between life insurance and long-term care, they're hybrids between life insurance, long-term care, and annuities. And they offer bonuses for the income riders inside the annuity that can help fund the policy. So if you have that saved $250,000, if you were to put it in there on a qualified basis, these contracts, it's actually going to distribute out $300,000 over time that becomes a non-qualified life insurance with long-term care contract. So we're going to look at isolating policies separately, and we're also going to look at doing policies as one, like that policy, and they incentivize you with these bonuses. So this is an example of a one-page sheet that we put together to showcase that if you do nothing inside of a qualified plan, you're going to have to take RMDs eventually, you're going to have to pay taxes, and even if you reinvest those taxes, you're never going to accumulate enough money that would equal what we could get on inside of one of these hybrid designs that we created. So if you take the same $250,000 on a qualified basis and you were to fund a life with long-term care contract, if you passed away, you would get significantly more death benefit tax-free than what the after-tax benefits are. And if you were to go on claim for long-term care, some of these policies actually have unlimited benefits. So there's no bigger pool than unlimited. And if you could take out $1 million out of a plan tax-free, whereas if you were taking it out of a qualified plan, it's always going to be taxable. It's a significant difference. So,
Adam, share with us briefly. Tell us a little bit about that 20% bonus. That sure seems like a pretty rich benefit.
Yeah, so it's an income rider, just like you'd see in an index annuity and a variable annuity. And what it does is it pays out to itself. So the reason why they offer you a 20% bonus is, one, because it's qualified money. So you have to defer or give them interest to offset some of the taxes that you're going to have to pay to distribute to buy the policy. So they're taking care of some of the taxes for you with that bonus. But also they're able to offer that bonus because it's paying themselves. They're paying themselves that money. So it's that's where the one product, one carrier solution is going to have more benefits than trying to do it on the outside. We can do it on the outside. We could do an IRA rollover into a SPIA and fund any number of contracts, and we're going to look at that too. But if you do it inside of one contract, they give you such incentives to keep all the money in the same company that it's really interesting. And that's one of the messages I wanted to leave people with today, and that some of the unique designs of these ABL contracts are really adapted and created to accept this qualified money, to accept this non-traditional type of funding, and it's showing. We're showing a lot more of this stuff, and people are buying a lot more of it than I've ever seen.
Adam, I think the most appealing portion of this page would be in column 17, where you're showing some hypothetical years of claim, right? And I know you can access $119,000 per year. And then in columns 15, 16, and 17, you're showing the cumulative reimbursement pool for a 3-year claim, a 5-year claim, and a 10-year claim. So the $1 million really jumps out, particularly if you compare it against column 4, where after taxes you're leaving a really subpar transfer of wealth. Give us some ideas on impairments that could possibly create a 10-year claim, and if you've seen them in the past.
Yeah, so if you look at the long-term care statistics, it's interesting. About 25% of all claims don't make it out of the elimination period. Unfortunately, if someone has stage 4 cancer, they could qualify for a long-term care claim, but they just don't live that long with it.
And an example of a longer claim, Adam, would be an Alzheimer's or some type of cognitive issue. Another interesting funding source, and Adam, anything else to add by way of these longer term claims? You had stated that some don't even get out of the elimination period, but how about a longer duration claim, like greater than 5 years?
Yeah, when you look at Alzheimer's, a cognitive impairment, something degenerative like Parkinson's disease, this is something that these claims can last a significant longer period of time. So you have those, and that's where you see the percentages when you hear that it's an 18-month average on a claim. Again, you have some claims that don't last 3 months, and then you have other claims that last 10 years, and that's where you get to that 18 months. But you have HSA money that can be used to fund these, and again, annuity funding as well. So when finally on the C Corp funding for long-term care, when you isolate these contracts, again, a 10-pay of $25,000 is completely deductible from the business, but the reportable income on the other side of it is you only have to report the life insurance benefits, not the long-term care benefits. So in this instance, on a 10-pay for a 60-year-old for $25,000, the long-term care benefits are $11,000 of that $25,000 premium. So the long-term care benefits are not reportable. So if you have a C Corp and you're a business owner, you do a 10-pay, you take a deduction of $25,000 for 10 years. That's a full deduction out of the C Corp, but you only have to pick up income for $13,970 a year. So there's a tax arbitrage there. S Corps also have that arbitrage, but it's not to that extent. And it's a significant opportunity for business owners that are interested in doing personal planning, interested in protecting assets, but they also are looking to fund it on a long-term care. They're looking to fund it out of their business. They actually have some tax incentives now, which is why it was relevant for this conversation.
Thanks, Adam. So we did a pretty good job on time here. At 12:45, we're approaching the end of our call. There are a couple questions that I didn't get to. We were answering them through the chat as the presentation was live. There's a couple we didn't get to that we will address on a one-on-one basis. But in summary, right, your eyes and ears should be open, right? Follow what's happening. If you're not active at AALU, at least sign up for their newsletters and see what's happening on the horizon and any threats to our business. It makes for a great topic with clients and centers of influence. Call any one of us on the line, your brokerage director at Life Brokerage, if you're interested in getting copies of these one-pagers or further discussion on any of the topics shared today. Given the time constraints, you couldn't get into too much detail on these subject matters, but hopefully this gave you some speaking points that you can use in your travels or in your Zoom calls. And again, the purpose of these webinars is to create demand. And it's been a challenging environment for you, and we know it. And the purpose of these webinars is, again, to help you speak to clients, create demand for life insurance and long-term care solutions. And again, we thank you for your attendance and your continued support. This call will be recorded within an hour or two of the close of this session. You'll get your copy along with the individual slides. So be safe, everyone. Thank you once again, and have a terrific weekend. If we don't catch you on the next webinar mid-December, have a terrific holiday season.
Thank you.